So our fearless forecast that we like to do at the beginning of every year pegged the Dow at 41,500. Lo and behold, this past week you saw the Dow above 41,000. And I guess the question that raises is, can that continue? What's history say? What should you be doing with your portfolio now in light of what's going on in the market? So we got some interesting historical perspective, and then we certainly do have some recommendations for you to implement as it relates to your own investments. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's one of Central Florida's longest running radio programs, coming to you on a host of radio stations throughout the Central Florida region. Also a top planning and podcast on the big wide world web. Check us out on any of your favorite podcast platforms, whether that's Spotify, Apple, iTunes, whatever the case may be. We've got a channel on each of those platforms, along with our YouTube channel. If you want to see what the inside of the Nelson Financial Planning radio studios looks like, you can check us out on YouTube as well. Any trouble finding us on any of those locations, go to our website, nelsonfinancialplanning.com. There you'll see the icons. Click on them. They'll get you connected. Once there, make sure you subscribe, because then you don't have to do that again. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great people who also happen to be certified financial fiduciaries as well, and they stand ready to help you improve your life with a successful and cost-effective financial plan. So, market this past week continuing to kind of hit record highs, and I guess it begs the conversation of, well, what next? What might happen next? Is there anything that I should be doing from an investment perspective these days that is different than what I might have done in the past? So for perspective, let's start with a little history lesson. So we're going to go back over the course of the past 75 years. Since 1950, the S&P 500 has reached 1,434 new all-time highs. Let me have that resonate just a little bit. Since 1950, the S&P 500 has reached 1,434 new all-time highs. So I'm going to think about that for just a second, right? As the market's going up, okay, hits another all-time new high on a closing basis. Okay, next year hits another all-time high. It might go down a little bit and then comes back up. It's another all-time high. That has happened 1,434 times over the course of the past 75 years. To put that into perspective, that's an average of almost 20 a year, averaging out to over one a month. Pretty remarkable occurrence when you really stop and think about it. Really a testament to the long-term viability, strength, and ultimately investment performance over time of the markets themselves. Pretty interesting numbers when you start to look at that, right? Hitting all-time new highs on an average of 19 per year, almost 20. Average of over one per month going back over the course of the past 75 years. Pretty amazing when you stop and think about it. What's even more interesting is that since 1950, each time the S&P 500 has hit its first all-time high in a particular year, then that market index has delivered an average return that's over 17%, 17.1% in the subsequent 12 months. So what that piece of information would say is, okay, just because you're hitting an all-time high in the market, it does not mean that you are in the process of potentially a big decline, right? Just because you're hitting a high doesn't mean a decline follows. In fact, the opposite would be true. Once the market sort of hits a high, then that means that it has some strength. There must be something positive going on in the economy, in the markets, and so consequently, you typically see it making more all-time highs. So sort of the opposite of sort of what you would expect to happen, if you will, from an investing perspective. So I guess it begs the question: what should you do, right? In terms of when you see this happening, and I guess the first point is that it's certainly not particularly a time to say I'm going to get out of stocks altogether and ultimately shift the entire nature of my portfolio, but it does beg the question of, is there something that I should do to maybe readjust or fine-tune my portfolio? Because the reality is, and we saw this just this past week with a particular client, with a number of clients actually, where, let's say we've got a target investment allocation that is 75% stocks, 25% bonds, something like that, okay? And the market does well, so the stock side does well. So what happens then is that because of the performance of the stock side, you may very well be looking at your portfolio and now, instead of being 75% stocks, 25% bonds, you may be 80% stocks, 20% bonds. So as a result of the performance, right, then you wind up with perhaps a little bit of a portfolio that is a little bit riskier than what you originally sort of set out in terms of your game plan for your financial future. So that's one of the biggest reasons to kind of review the portfolio, is that chances are, particularly if we look at performance over the course of the past few years, then your stock portion, if it should have grown, and so if it has grown and the bond portion probably hasn't grown because we were in an era where interest rates were increasing, so that cuts down on the ability of bonds to appreciate, to go up in value, then your investment mix that might have been 75-25 or 70-30 a couple of years ago is probably more like 80-20, 80% stocks, 20% bonds, 85% stocks, 15% bonds, something like that. You hopefully get the idea, the concept, which then means that, the first thing, obviously, is you need to be reviewing your portfolio and looking at this stuff first and foremost. But it really begs the question of, well, at the end of the day, it's probably time to look at doing some kind of a rebalancing. And what that means is that you're looking at your portfolio and you're looking at what are potentially some areas of concentration that are different than what it was then when you first set up sort of the investment allocation that you chose for your retirement. And so if you look at it and you may say, well, I've got a much higher level of growth now, which would make sense because a lot of the growth in the market is from these tech stocks, and so I'm gonna shift out of there and put more into the dividend paying side of things, or maybe I'm going to use that to recalibrate and get back to the balance and the mix that I had between stocks and bonds. So I'm going to actually trim that and trim that out on the stock side and put that more into the bond side or the conservative side of my portfolio. So certainly, those are the kinds of things that you want to be thinking about, particularly in light of sort of where the market is, particularly when you're reviewing the portfolio. And this is certainly a theme that we've been talking about for some time now. You really also want to look for concentration. Look, the reality is that a lot of the performance of the markets as a whole has really been concentrated in a small handful of companies. We've heard the expressions of the FANGs and the Magnificent Seven, and pretty much this year it's just been NVIDIA. And how that impacts your portfolio is the narrower it gets in terms of a narrower selection of stocks ultimately driving the investment performance. You're getting concentrated, and it's all fine and dandy when it's going up, but the problem is that nothing goes up forever. And so consequently, when you see some reaction in the market, it's going to impact that much more. So those are the things you need to be careful of, because the reality is that the 30 largest stocks in the S&P 500, so 30 out of 500, that's not a lot, now have a combined weighting of over 50%, 53% in fact. So those are the things you need to kind of really be thinking about as we observe what the market is doing based on hitting new highs. So with that, we're going to take a break and continue the conversation here on Dollars and Cents with Joel Garris of Nelson Financial Planning.